Welcome back, and joining us for a look at the day's market moving news is Annatjie Van Rooyen from MyWealth Investments. Thank you so much for your time, Annatjie. Now, the JSE sunk deeper into the red after it traded relatively flat for most of the day. But really what was noticeable there was the resources complex that actually carried the bulk of those losses, and also the weakness that we did see in the rand. At some point, it was down more than, it weakened more than 2% against the US dollar. And I mean, this is even as China's stimulus that was announced a few weeks ago came into effect today, which is a good thing. So what has awoken risk-off sentiment today?
Hello, Annatjie, and thank you for having me. Well, first of all, as you have mentioned when you read the news, the non-farm payrolls number on Friday, it was a much hotter jobs report than what markets were expecting. Very strange, because even although the December number was revised sharply higher, it's difficult to understand how the forecasters can get it so wrong that the actual number can come out nearly double than what was expected. Yeah. So obviously then that caused investors to be concerned about the interest rate cycle, and perhaps thinking that interest rates will be on hold in March and rather be moved out to the meeting at the Fed meeting on the 22nd of May. But the thing is, even though that jobs report was hot, I think that just shows the resilience of that American market, and also the fact that the Fed will be able to avert a recession. The narrative of moderating inflation remains intact, 100%. The latest PCE print was 2.9%, and the Fed can't wait until it reaches 2% before they pull the trigger. So I'm still in two minds. I don't think a March cut is off the table completely. Yeah. And then, of course, on the Chinese side, like you have mentioned, the Chinese policy priorities still lack that urgency for counter-cyclical initiatives. Yeah. That's the one thing. They're not aggressive enough. And then secondly, we might possibly be viewing a de-risking ahead of the Chinese New Year, which will be kicking off on Friday. So the Shanghai market will be closed for a period of 1 week. So I do think that can definitely have an influence on the market's performance. And then you actually asked me so many things in one year, but then the rand depreciating, and you also mentioned the lackluster PMIs, but yeah, despite that, we also saw the print from National Treasury for the budget deficit, which has widened from 5.7% to 6%. Yeah. And that is the largest print in 2 years, I think. So that, and the increase in populism and the increase in uncertainty running into this budget speech on the 21st of February, as well as the elections that we are heading into, I think is causing a bit of jitters at the moment. But America is still on track for inflation to come down to 4.5% towards the middle of the year. So that narrative has not changed yet. Yeah.
All right, well, let's go into company news. And I was saying off air that MultiChoice makes movies, but they've become the latest movie that investors are watching right now. So, of course, they've withdrawn that cautionary announcement that they had on the potential buyout offer by Canal Plus. But also at the same time, Canal comes in and now buys more of the MultiChoice stake. We're now at more than that 35% level that would trigger a mandatory offer. What are you making of this? I mean, does MultiChoice have us on the edge of our seats right now?
Yes, well, I like the way that you describe it. So maybe the subscribers will also pick up now that they're making these action movies because everybody is watching the movie. Exactly. No, it's a complicated situation because it operates in a specific regulatory framework, and there is a regulator involved. So it's not easy to explain when that offer, the mandatory offer, will be triggered and how it will happen. But obviously, MultiChoice does feel that they're not being compensated for the synergies that they will add and bring to the table. They probably want between 20 and 30% more to justify a buyout. But I think for me, the bottom line is that whenever assets are undervalued, you always find the large corporations lurking around, picking up undervalued assets. And that that just means, watch this space, because even if it's not this corporate, somebody else will come along. So I think it's just put MultiChoice back on the map, and people realize that you're sitting with an undervalued asset here, which looks very attractive.
Well, we are glued to our screens. Let's take a look at Italtile that released an interim trading update today saying that they expect their HEPS to decline by as much as 17%. We did see that share price plummeting more than 3%. But I would have thought, I was quite surprised by that market reaction, because I would have thought that the market had fully priced in this kind of bad news from Italtile.
Yes, it's interesting. Italtile, with such a solid company with a solid track record, solid management team, they didn't really elaborate on where that loss came from. But I doubt whether it has anything to do with operational inefficiencies. In my mind, I would say it's purely because of the high cost of living and South African consumers that are cash strapped, and people prioritizing their expenditure and rather focusing on necessities than perhaps renovating properties and the product that they are producing. But I still think Italtile is well positioned for where we currently are in the interest rate cycle. As soon as it turns, then those will be the stocks that will perform well again. So this might just be a very nice opportunity.
All right. Well, where else are you seeing opportunity? Your stock pick for today, Annatjie?
I'm going to be very defensive because there's a lot of uncertainty around. We're heading into the budget speech and the upcoming election. So I'm going to be defensive, and for that reason only, I will pick Absa, which is the cheapest of the 4 banks in South Africa. And the main reason for my stock pick is the dividend yield. So you're probably going to get in excess of 5% when they report their full year results, and then you're looking at a forward dividend yield of 8%. So if we go into a period of a bit of volatility and uncertainty, nothing wrong with collecting that dividend while you're waiting. So you can always switch into the exciting tech stocks after you've collected that dividend and once the election is out of the way.
All right. Well, thank you so much for your time and for your insights on what has been driving investor sentiment today, Annatjie. Appreciate it. That was Annatjie Van Rooyen from MyWealth Investments.